Welcome to Markets in a Minute. My name is Austin Duke. I am financial advisor and chief investment officer for Diamondback Financial Services. We are a wealth management firm focusing on clients who recognize the need for solid financial advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, February 23rd, 2026 edition. Let's get started. Investment values fluctuate on a daily basis, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. Diamondback Financial is a long-only investment firm, which means we keep your money invested in areas that we feel offer the best prospects for growth instead of trying to time the market. We focus exclusively on traditional investments of stocks, bonds, and cash. So we'll analyze fluctuations in the stock market and interest rates to help drive our overall investment decision process. For the past 2 weeks, we'll start with the stock market as measured by the S&P 500. Again, this is an index of the 500 largest companies in America. And over the past 2 weeks, we had a 0.33% decline, which 2 weeks ago, we said we wouldn't be surprised if we were flat again over the next 2 weeks, and we were essentially flat for the last 2 weeks. So we have a year-to-date gain of 0.94%, which is fine, but it has been pretty low volatility and pretty flat over the past 6 weeks now. Next, we'll look at interest rates as measured by bonds issued through the U.S. Treasury Department. Again, interest rates are what we consider the preeminent measure of investment risk. Rates are factored into every valuation calculation, including stock valuations. And generally speaking, as interest rates go down, stock prices will go up. And if interest rates go up, stock prices will go down. We have interest rates listed over here on the left-hand side. We've got maturity lengths on the bottom axis from 1 month all the way out to 30 years. Each of these dots represents an interest rate for a given maturity length. The green line is where we finished on Friday, the 20th of February. Brown line is where we were 2 weeks ago. Basically no change to these short-term interest rates. The 1-year rate went up barely. The medium-term to long-term rates all came down a little bit over the past 2 weeks. The U.S. 10-year Treasury, as you can see, over the last few weeks has been in a bit of a decline. Some of the economic data suggesting that maybe the economy is not doing quite as well. We've also seen some reports about unemployment not being as fantastic as we would like it to be. So there's a lot of different opinions on the direction of interest rates. The good news is that the 30-year mortgage for buying a home is closely correlated with the 10-year U.S. Treasury bond. So as this rate comes down, the borrowing cost for those who are looking to get homes also comes down. So we have seen a little bit of an increase in home applications, but real estate market's still struggling and has been for the last couple of years. We also like to look at the high yield corporate bond spread. This is the additional interest that you are demanding from corporations above and beyond investing in a treasury bond, which is considered risk-free. And the spread between what the risk-free bond is paying versus what a high yield corporate bond is paying has been in a bit of an uptrend here for the past month or so. This can be a combination of the spread increasing due to higher probability of default for these corporations, but it could also be a reflection of that decline in the U.S. Treasury bonds that we've seen over the past few weeks. So hard to know for sure which direction it's actually going at the moment, but it is trending a little bit higher, but still not at a place that we would feel any concern that something more nefarious is in order. For recent developments and expectations, we have two stories to share. We're still dealing with the artificial intelligence, I guess we'll call it uncertainty. About a week ago, we had a significant drop in the stock market, at least for the NASDAQ 100, which is mostly the technology names. But as we are watching what's happening, we're actually more impressed with the broader stock market as a whole, as opposed to just the the largest companies driving the market. So it felt like for the past 3 years, we really had the Magnificent Seven, or, again, the largest companies doing the best and driving positive returns for the market. If we look at the performance of these individual names over the past, I guess we'll call it seven weeks so far this year, by and large, the contribution that these companies are putting forth is negative contributions. We have a couple that are showing some small positive gains, but Microsoft not doing super fantastic. So if we were to look at the 493 other companies in the stock market, that's where we're seeing the growth. And so it's very interesting, but it's also it should be very comforting knowing that we're not relying on a handful of large companies, but we're now finally getting some of the benefits of having a lot more smaller companies participating in the stock market going up. So, despite all of the jitters that we're seeing, and despite all of the we would call it maybe like little mini bubbles bursting here and there, it's not like the entire stock market's collapsing, but we're seeing some mini bubbles bursting. Or if we blow up a balloon, we can pop it, or we can just let it deflate. And so maybe some of these names, some of these larger companies, after having a really solid 3-year run, are now just letting some of the air out a little bit. So we don't necessarily have to crash. We don't have to have a big pop in the market, but we can see some of that deflate and maybe then become absorbed by some of the smaller companies, and keep the market afloat. The other big news, obviously, was on Friday when some of the tariffs, not all of them, some of the tariffs that President Trump implemented were struck down by the Supreme Court, and the stock market went up, right? So I think it was widely expected that at least some of these would be declared unconstitutional. And President Trump's already gone to Plan B, and there's other provisions or statutes that he's able to use to implement some tariffs, at least temporarily. Um, our expectation is that they will be temporary. President Trump has to know that these are very unpopular with the voting class, and with a midterm election coming up, we think that he'll end up refunding the American citizens with a tariff dividend, or however he's planning to spin it, so that he can appease the courts and he can get money back into our pockets before we head to the polls in November. So that's kind of our forecasting at the moment. But yeah, we'll see how that shakes out. All right, as a final word, we may have used this analogy before, but we like to hit base hits when we are investing. We don't try for the home runs. And the reason for that is because even though home runs are flashy, it's not the best predictor of actually winning games and ultimately winning championships. So on the left here, we've got our friend Ted Williams, who became famous for hitting in a single season. His batting average was .406, which means he basically got on base 40% of the time he went to at bat, which is not a high percentage, generally speaking. On the right, we've got Roger Federer. He is a famous tennis player who won nearly 80% of his singles matches. But when you break down the points within the match, he was winning about 54% of those points. And he attributes his success to winning what he would call the big points, right? The ones that would lead to either a break point or to winning a set point, and that would lead to winning the match. We did some analysis on the stock market. It's been about 10 years, but we wanted to see how many days over 100-year period does the stock market go up versus down for a daily return. And it's pretty close to that 50%, 51, 52% for up days versus down days. So, not a lot of disparity, and there's really no way to predict from one day to the next if it's going to be up or down. But over time, those positive days accumulate at a higher rate or a faster rate than those down days. We also observed that the number of up days that were 1% or greater were more frequent than on the downside of being down 1% or more. So again, we can't necessarily predict from one day to the next what the stock market's going to give us. We're trying to keep you invested so that we can get those base hits, so we can get those 1% updates or better as they happen more frequently, knowing that we will end up enduring some of those down days and those 1% or greater down days. But ultimately, we want to keep you invested. We want to hit for base hits. We want to get on base, and we want to be there for those opportunities to win games and ultimately win the championships and achieve your financial goals. So uh, thanks for letting us indulge on a sports analogy. We appreciate you guys. Hope you have a good rest of your February and a good start to March, and we'll see you soon.